Hello options traders, welcome everyone, and I hope everybody had a great weekend and off to a good start here in the markets. And I wanted to kick things off with another trading video. This one's geared a little bit more towards the new traders and especially those who trade short-term options. It's really going to be the first of a two-part series. The next video I post is going to get more into the application of what we're going to learn in this video. So for today, what's an options maximum value? It's kind of an intriguing question. Sometimes people don't even give it a second thought, but if you ask most traders, they will tell you, well, the longer the time to expiration and the deeper in the money you go and the more volatility, the more expensive the option becomes. And that's partly true. So a lot of this is going to go against your intuition, might even make your head hurt a little bit. So enter at your own risk, but it will be very important to succeed with options trading. So let's take a look at what's an options maximum value and why does it matter? Well, first of all, whenever you're trading, anything for that matter, you always have to consider the alternatives. So when you are trading options, what are you tied to? Well, it's a derivative. You are tied to the stock or whatever the underlying is. So for this video, I'm just going to assume that we are trading individual shares of stock. So whenever you're going to take off on a particular strategy and come up with some outlook, whether you think the stock is going up or down, you have to consider the alternatives. What are my choices? What do I get to choose from? Well, the first one is very obvious. You can trade the shares of stock. And when you do that, you are going to rise and fall dollar for dollar with that underlying. It's what we call a delta 1 gamma 0 position in the options world. If those terms are new to you, you can go back in this forum here and you'll see the Greeks, you'll see delta and gamma, and that will help to explain those terms. But it just means that that stock always rises and falls dollar for dollar. That number never changes, that plus and minus 1. That's where the gamma 0 comes from. So that's the first thing you can trade is shares of stock. Now, most people know there's some big drawbacks. We have to pay a lot for it, and if the stock heads south quickly, we can also lose a lot. But that's really one of the first choices you get. What's number two? Well, you could go into the single stock futures, which is really a levered version of the stock. You usually get about 5-to-1 leverage. But I can show you how to do even better than that with even less risk by using the options. But it's another choice. And we would still have delta 1 gamma 0. Again, it's going to trade just like the stock, just with some leverage. What's the third thing we can do? Well, we've got options. And that's really about it. Those are really your choices to tie yourself to shares of stock. When you're trading options, though, this is where people start to get all kinds of confusion entering into the strategies. A lot of traders believe that when you're trading options, you are trading cheap shares of stock. That might be true, depending on the strike you're using, and I'll address that more into the next video. But in most cases, it's not true. In most cases, when you're trading the at-the-money, short-term, and out-of-the-monies, you're really trading lottery tickets. You're really the furthest thing from shares of stock. Now, on the flip side, let's take a look at that too. Lots of confusion here. You'll hear traders say, well, I only trade shares of stock because those options are too risky. Not true either. Because I'm going to show you here that mathematically, stock traders are trading an option. And I know you're probably thinking, what? How is that even possible? Well, mathematically, if we make an option strike 0, there is no such thing as that, but theoretically, if we listed a 0 strike option and we gave it an unlimited time to expiration, it would trade for the stock's price. So think about that. If the CBOE listed an option right now that said you can buy this call option, 0 strike, which means at any time you can exercise it into shares of stock and pay nothing for it. And you've got an unlimited time to expiration to do it. Ask most traders and they'll say, oh, geez, that's going to be an outrageously expensive option. No, it's not. It's going to be worth the stock. So the first thing you have to understand that in options maximum value, depending on the calls or puts, there are limits. So for the call option, the most a call option can ever be worth is the underlying stock. And the reason there is because it can never be worth more than the underlying that you can exercise into. Think about it. Doesn't matter. Pick a strike. If that stock is trading at 100, the most that option could ever trade for is 100 because it would be stupid to pay 101 for something that's only worth 100. So that's the absolute maximum that a call option could ever be worth. What about a put? Well, a put, you make money if the stock heads south. What's the lowest point a stock can go? To zero. So if you exercise that put, the most you can make is the strike price. So for the put, the most a put option can be worth is the strike. Now, yes, we're generally going to need very large stock price movements to hit these limits, but they are important to understand to successfully trade options. This is so important for all of you short-term traders. So let's go to a pricing model and see how this works. All right, what you're looking at here is the CBOE, the Chicago Board Options Exchange's pricing model. Easiest way to do that is go to Google and just type in CBOE pricing calculator and it'll bring you to this page. But it is simply a pricing model that generates the theoretical price of an option. I think most of you know that there are 5 key factors, 6 if you include dividends. We have the stock price, the strike, days to expiration, volatility, interest rates, and if we have any dividends. But I'm going to leave those out. And when you click on calculate, it tells us the theoretical price of a call and a put. So in other words, if the stock is 100, strike is 100, 30 days to expiration, 20% volatility, and 0 interest rates, that call option's worth about 228. Same for the put. Now this is right here a true option. It's at the money. There's no intrinsic value. It's all extrinsic value. These are the things you really have to be careful of, especially for short-term traders. It acts like a point spread on a football bet. You need to, in this case, beat the first $2.29 of that stock price movement. It's not going to count for you at expiration. Another way to see that is your break-even point is the strike price of 100 plus 229, let's call it. So the stock's got to get to 102.29 just to break even, and it's got 30 days to do that. That's a 2% move in a month. That's a healthy move. Probably not going to happen, and if it does, you just broke even. Hardly a big reward for your efforts. But what would happen if we started cranking up the time to expiration? What if we made it, let's say, 360 days, gave it about a year? Yep, starting to get more expensive. More time means more money. But what if we gave it a ridiculous amount of time? We really cranked this thing out. Let's say it was 5,000 days or nearly 14 years into the future. Now, there are no options that go out this long, but theoretically, what would it do to our prices? Click on calculate. Goes to about $28 for the call and put. Let's go up to 100,000. Getting up to 90. But notice that we're starting to close in on the stock's price. What if we made this 300,000? Look at this, closing in on the stock's price. We're not getting into more and more expensive options. We're starting to trade shares of stock. There it is with 500,000. Let's give it like 800,000 days. It's still really hard to get it to converge to 100, but you can see that we're closing in on 100. We just can't get it to go past 100, and we are delta 1, gamma 0. This is shares of stock. It's not an option anymore. It was not an option a long time ago, and yet it would scare people to death to trade this thinking that it's a very, very expensive option. It's not. It's shares of stock. Again, because we got delta 1, gamma 0. There's no extrinsic value on here. Well, let's take this back down to, let's say, a more reasonable level. All right, well, what would happen if we increased volatility? Well, little hint, volatility is just another way of affecting time. I can give an option more value by either giving the stock more time to move, potentially rising higher, increasing the value of the call, or falling lower and increasing the value of the put. I can also keep the time constant and give it more volatility. In other words, give it more ability to move in the same amount of time. So there are really 2 different ways of accomplishing the same thing, not to the same degree, but increasing volatility is conceptually another way of increasing time. So we should get the same effect. Of course, we're going to have to get into some very high levels before we're going to see it. So let's make volatility 1,000%, something you'd probably never see happen, but click on calculate and look at this. Call and put moving right in on the stock price. Let's make it 2,000%, and there we go. And you'll just see that you cannot get above this number. What if I made it 3,000% volatility? Doesn't matter. What if I gave it 1,000 days to expiration? Doesn't matter. we're closing in on the stock's price. That's the maximum it can be worth. And you're seeing that the put is closing in on the strike price here. Now, what would happen if I lowered the strike? What if I made this, let's say, a $20 call? Click calculate. Again, not affecting the call price. It's behaving like shares of stock. My put, on the other hand, has now converged to 20. The strike, that's what I said in the previous slide. The most a put option can be worth is the strike price. Well, if I change the interest rates, in the real world, it would be very difficult to see these actual numbers because the interest rates will play a factor. Let's give it, let's say, 2%. And you can see now it is starting to depress the put price a little bit, partly because we've got so much volatility and so much time to expiration. But the main point is that if we lower this strike, which is something that most new traders are fearful of because they think that they're making it a more expensive option, you're not. What makes an option is the extrinsic value. We're getting away from the extrinsic value. We're making it behave like shares of stock. And in fact, this is a condition called parity. When we see that the delta is 1, or at least very close, and gamma 0, and parity is just a fancy word meaning that the option is now trading equivalently to shares of stock. It's lost its optionness, so to speak. It's no longer an option, it's shares of stock. But look at what happens. I can get these for a whole lot less money than I can for shares of stock, and that's what we'll look at in video number 2. But right now, what I want you to see is that as you start lowering your strike price and you start increasing the time to expiration, those are really the two things that most new traders are most fearful of, going to lower strikes and longer dated options, because they think they're getting into more expensive and riskier options, and they're not. They're moving towards shares of stock. So just for one final demonstration, let's bring the volatility back to a more normal level. Let's make the time, let's say, a year. And let's make this the $100 strike. So we'll reset this here, $9. $9.24 on that call option. Yeah, this has got some risk to it. We need that stock to rise $9.24 in a year just to break even. So what's going to happen if we lower the strike? What if we go to an $80 call? Well, yes, it appears to be a more expensive option, but how much of that is intrinsic value? With the stock at 100, the $80 call is worth $20 of intrinsic value or cash. So we only have $3.04 of extrinsic value. This really isn't much of an option anymore, and we can see that down here with the delta 91, gamma basically at 0. This is getting pretty close to parity. It's far more like shares of stock. But notice that I'm buying stock for $23 instead of $100. There's almost 5-to-1 leverage right there, and I don't have to post the margin that I do for a single stock futures contract. You can't even do this intraday as a pattern day trader in a margin account. And yet we can do this, and that's the absolute most you could ever lose. How much would you lose on this option from the passage of time? Just the $3.04. It's only the extrinsic value that can be lost. But you can see that if I start lowering this strike, lower and lower and lower, we start getting closer to 0, I don't get into some outrageously expensive option. I'm just converging on the stock. Let's see if it'll let us go down to 0 here. It might not. Yeah, it won't. But let's say if we gave it a strike of 1. Yeah, the option is now trading virtually for the stock price. It's not getting into something outrageously expensive like most people think. So as the strike starts getting lower and lower, you are getting away from an option and more towards true cheap shares of stock. So the main thing to understand, especially for all the new traders out there who like to trade short-term options, I'm not a big fan of that for a lot of reasons, which I think I've made very clear in a lot of these videos, but people still do it, and that's a trading style. And if that's your thing, that's fine. But what you need to do is make sure you are getting away from the option and into shares of stock. You need to trade something that can start moving quickly with the shares of stock. And that means you need to go in the money. Now, the good thing about trading short-term options is that if you go in the money, they're going to get towards delta 1 fairly quickly. And so, yes, we can make these behave like shares of stock. But again, notice if we did, let's say, an $80 call, trading for $23, most traders think that's an expensive option. And you really have to understand that if we crank this down to, let's say, 20 days to expiration, I mean, look at it. $80 call, trading for $20.12, that's 12 cents of extrinsic value. You've got delta 1, gamma 0. That shares a stock with 5-to-1 leverage. This is more of where you need to trade if you are convinced the stock is going to move higher. You don't want to be trading the at the monies and the out of the monies. And unfortunately, that's what I see most of the traders, especially all the new traders out there, trading. And they do it for a simple reason. They think they are trading cheap shares of stock by trading the at the money short term. And you're really trading lottery tickets. It's a hard thing to understand and to see, but hopefully this demonstration helps you to understand that as you go deeper in the money and or longer dated expirations, you're really moving into shares of stock, but you're just doing it for much cheaper prices than the actual shares of stock. That's where the option advantage lies. So for any of you short-term traders who are struggling with making profits and finding out that the stock is moving up and your options are just not responding, or you're still ending up on the losing side, move those strikes in the money and you'll see immediate improvements. So I hope that helps. I'm going to upload a second video, a follow-up video later in the week that will show a more practical side to trading based on these concepts. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. And if you're looking for some free information, some great market commentary, please join us on the Facebook trading group Options A to Z. And we'd love to have anybody who's interested in the art and science of options trading to please join us on this group.